Thank you very much, David, for that. Yeah, so thank you for having me back, and I'd like to just kick off with the importance of deep water to global supply. And we'll kind of break it down into oil and natural gas because that's quite important in terms of discoveries in the deep water in the last couple of years, potentially kind of underappreciated how much gas we're actually finding. So let's kind of just go straight into it here. First point is, and again, I'm going to be showing a lot of charts. I'd love to show a lot of maps, but fortunately in my area, it has to be backed up by numbers. So you're going to see a lot of charts here or graphs. Exploration expenditure continues to rise. So the appetite is there to explore. And even after 2008, 2009 period, when it kind of dropped off a bit, it has come back really strongly, encroaching on $90 billion a year of exploration spend globally. And that's kind of gone up 14% a year over the last 10 years. Big chunk in North America, as you might imagine. But then, South America really gaining share here, and then equally spread across most of the major regions where you've seen exploration happen for the last 10, 15, 20 years in terms, certainly offshore. And we would expect that number to keep increasing. At least confidence levels seem to be high within industry, comfort with the oil price. So that's an uptrend we expect to continue. But what is actually delivering, and this is one of my favorite charts, just kind of track as best we can all of the annual discoveries of oil and gas every year. And obviously we'll have to update this chart soon with the contribution from unconventional resources. So this is just conventional oil and gas discoveries. It is starting with the onshore in green, as you may have seen this chart before from us, and then just showing the deep water contribution over the last 12 to 15 years in blue here, green being onshore, and then the red line just being combined oil and gas consumption every single year. So, we are just beating the annual consumption, but we're going to examine what's inside the blue area in a couple of slides' time. So again, but think about the last 10 years, 50% of those discoveries have been deep water. So a big pipeline of offshore discoveries still have to, let's say, be developed. And I mean, the maps I can show is that when you do take some of the basins that are seeing this progression into deeper and deeper water, the US Gulf of Mexico, you can get all the wells and you can plot them very readily. And here you can just go step back 10 years, 2001 to 2011, and you can see the kind of shallow part of the basin here, and then the topography as it kind of dips into the deeper part. And you can see here 10 years later how you're getting a greater percentage of the wells drilled in deeper water, which we're going to discuss. So it's all, increasingly moving deeper and deeper. And that's what you see when you just simply look at discoveries by water depth. And as you start up here at 500 meters, and then you start to get up to 1,500 meters average water depth for discoveries in the last, if you look at the last 7, 8 years, that's been the water depth where we're finding most of our discoveries. And crucially, it's important to test those water depths because that's actually where the biggest volumes are being found. If we look at the categories of water depth, 0 to 500, 500 to a kilometer, and then a kilometer plus, the average discovery size here going from 150, 175 million barrels of oil and gas equivalent, up 300 and up to 600 on average. So that's a pretty impressive target for companies to be pursuing. And again, I know David usually kicks off with a statement that the best place to find oil is in a oil-producing region, but in the last 5 years especially, it's been the frontier regions that have really delivered the best average discovery sizes, 700 million barrels. So that's, again, we're going to talk about what's within the breakup of that type of number, but very sizable numbers just in the last 5 years. And again, it's illustrative to kind of plot it in this fashion and just monitor the trends, the phases of discovery. So you go back into the 70s, big discoveries this is water depth on the y-axis, and then obviously time here, and all the discoveries that we track plotted, and the size of the circle is the size of the discovery. So, big discoveries here in shallow water, a period of very little happening here. Then the late 1990s, 2000s, big discoveries across increasing water depth, so the trends we were talking about before. And then in 2002, right up to 2006, you kind of saw that just die off. I mean, there was a real reduction in sizable discoveries. And I guess if we're sitting back in that period, we might have thought, okay, the deep water's not going to actually offer us big sizable discoveries again. And you know, like conventional shale gas, it kind of turned the world upside down. When we track the last 5-6 years, we really see new plays and what they've actually delivered. So this is a period of new play identification, increased exploration spend, as we saw in the first chart, and really delivering very sizable increases and across all water depths. So it hasn't been just confined to the deepest part. This is Brazil, really up here. But the last 2-3 years, I mean, you're just seeing a nice steady recording of discoveries across the whole range of water depths here, and primarily those are really new play ideas. So that's, you know, really quite exciting in terms of resource. Obviously, we have to think about what does it mean for global supply, being the title of this particular talk. One way to kind of tackle that is to break it down by water depth, and that's what we're doing here with the lines, which is the percentage of supply from firstly onshore in black. And it has gone from, you know, 90% in 1970 down to 70% here in the year 2012. So it's dropped 20%. Shallow water, being the blue line, has kind of increased and taken some of that share, but falling off here in the last 10 years. And that drop off has been captured by the deep water. So deep water really only starting to contribute to global supply in the last 10 years, but still only 6.5% of global oil supply at this point in time, despite that capex, despite 50% of discoveries in the last 10 years from the deep water. It's not yet a meaningful proportion of oil production. And that the green area is just giving you an average depth of the producing barrel, which is only 100 meters, and that's simply the high weighting to the onshore still at this point in time. But again, a trend that we would expect to see increase. Natural gas, kind of shows you a similar trend here. So just doing the same for natural gas, back, you know, from sub 90 down to 70%. But again, the red being deep water natural gas production, still only kicking off in the last 10 years, but only about 2-3% of global gas production at this point in time. So there's a big resource set sitting there. It's in the development queue, not yet contributing too much in terms of volumes. So the question is really to think about that. How big will it become? Is it attractive? Is the appetite there? Are the resources sufficient quality, et cetera, et cetera? And it's just useful to think back to some of the prior periods of production, whenever the shallow water started here. So this blue area here being this category of shallow water production, 50 up to 500 meters. It did look small back here, and you know, just think about the trend. It just slowly increased as the pipeline of resources kept being developed. So I think it's a useful analog to think about what could happen this portion of deep water and ultra deep water production, which at the moment remains quite small, but what is the forward trend? That's what we're trying to get to. Okay, so again, I mean, this is just trying to highlight the same point, the same hypothesis at the beginning. If we think about the shallow water here on the left, and we think about the big producers in the late 70s, 1980s, really ramping up here to 4 million barrels per day of production, largely the UK, Norway, and Brazil. Did it just, you know, it started to tail off here? Did it slow? No. If we go back to that prior chart, that's the point. It just kept growing like this all the way through the next 20 years. So again, if we look at the deep water, it has reached 4 million barrels per day from ultra deep water Brazil, US, Angola, Nigeria. You could be tempted to say it's reaching a limit here. But again, just thinking about that back order, the backlog of prospects would indicate to us using this type of analog that this is not the end of this contribution from ultra deep water into global oil and gas supply. So now we think about how feasible it is just to assume a nice steady progression of deep water production in terms of the mix. And you have to think about the actors involved here, and then when you split it down by company, clearly this remains in the realm of the larger operators, as I'm sure you're aware of. And if we think about the 6 million barrels per day of deep water oil production today, you know, 20% of that is still Petrobras. Another 40%, 50% is the biggest 5, 6 integrated oil companies, as you can see here, and then running down into some smaller players picking up the last 1,000,000 barrels per day. So still very much a domain of the big operators, and that kind of talks about the pace of bringing these on stream. It's, you know, I always think it's interesting to think about how fast resources get developed as we analyze it. If you think about Russia, 10 million barrels per day, very slow to bring on projects because there only is one or, you know, 200-300 companies, and everything just takes an extended period of time. But you think about the US doing an equivalent level of production, including condensates, 9.5, and there's 28,000 companies every day trying to bring out a new barrel or a new molecule of gas, and everything does happen an order of magnitude faster. So it is important to think about how many participants are operating within this resource base. This isn't a lot, so it kind of errs more on the side of caution in terms of the pace of supply coming through. Added to that is one of the, won't be a surprise to anybody, is just the costs of doing everything, and it's always illustrative again to think about the order of magnitude increase here, 2 orders of magnitude increase in well costs as we go into these deeper waters and into these frontier regions. So onshore mature, $5 to $7 million per well. Offshore mature, $50 to $60 million per well. Some of the new plays that are being tested, up to $250 million to just test that first frontier well, and sometimes it works, as in the case of this well, Zidias, but you think about ExxonMobil's foray into the Santos Basin of Brazil, spending 3 times that, 3 wells of that magnitude, and not finding anything. So it's clearly in the domain of the balance sheets of the bigger companies. So, but I mean, as David was giving his analogy about the boys playing football and just rushing around the football, it's the same thing that we see here. New basins, new license rounds are coming, and the majors are certainly running in all behind one another to lock up all the acreage. So you know what's happening in the next, in 2013, 2014, we will be seeing, this is Subsalt Angola as one of the new areas we haven't yet encapsulated within our reserve database. We're going to find a lot more about this next year. Subsalt Angola, all the licenses here with the bigger operators as you would expect, Total, Statoil, Repsol, BP, etc., etc. So again, just pointing to new plays come up. They are expensive. They are seemingly remaining the domain of the larger operators, which gets back to the pace of exploration, the pace of supply coming through. And you know, post that, since that, you've had Uruguay in 2012, and again, kind of locked up by all of these types of companies here. So the other side too, so it's an attractive proposition. The bigger companies are pursuing it. What are the risks in terms of thinking about the contribution of oil and gas production into global supply? Well, you'll all be very familiar with decline rates, and this is the key thing with the offshore basins. They have significant decline rates. And this is 40,000 wells that we've analyzed across UK, Norway, and the Gulf of Mexico. And if you just take the median annual decline rate across all those wells by basin, you start to get, well, you see the numbers are big. So 12% in UK, slightly less in Norway, but up to 22% in the Gulf of Mexico. And the blue areas are really showing you fields where there's limited further development drilling happening. So if it's a tail end of production or there isn't a new well drilled, you really see these fields falling much more rapidly. I mean, it's really scary numbers. And to be honest, you're seeing this, you know, if you take the Gulf of Mexico deepwater, you've had a moratorium, so you're not able to drill all the development wells you wish to. Hence, we're starting to see more decline rates like this come through the production numbers from companies. You know, and companies like BP and ExxonMobil are kind of highlighting this type of decline rate on their major assets. So that's one side of the risk. You need to have the continuous development strategy. But on the flip side, it's incredibly attractive. And when you just, you know, go into one of these basins and think about water depth increasing here from bottom to top. So, you know, shallow water down here going to over 2 kilometers water depth up here. and you just think about the average flow rates per well that are coming out, you know, it still is 1,000 barrels a day or less than 1,000 barrels per day. In the shallow water, you're getting 10 times that as you step into the deeper water. So very much attractive to go off and drill these wells, because and then when you analyze the kind of slope here, I mean, the decline rate isn't actually that different in the US Gulf of Mexico depending on the water depth. So if you do, people perceive it to be challenging, difficult, etc., etc., the decline rates aren't materially higher than the other water depth terrains in the Gulf of Mexico, but you're getting out significantly more oil. And that feeds into the reason why we will continue to see increasing investment into the deep water basins, is because when you have wells that actually produce more and faster, so this is an example of the Gulf of Mexico in green versus the North Sea, the Gulf of Mexico having higher flow rates per well on average, and you end up getting all the oil out in a faster period of time. So, you know, this is volumes versus time. And what that means is that when you convert that into economics, or the net present value, you end up with much higher unit economics for Gulf of Mexico wells. And that's why we continue to see the rigs and the investment flowing into that particular basin, and we expect that to continue. Other basins that are being looked at, obviously we spoke about Brazil, and you know, there's not a lot of data yet on Brazil, but when you look at flow rates per well, and this is a range of US and Brazilian actual subsalt wells, so these are all subsalt wells, the green are Brazil, you start to see some really impressive flow rates. So 20, in terms of the green numbers, 20 to 30,000 barrels per day of light sweet crude coming out every single day. If you just average them up over here, you know, you are getting this 20,000 barrels per day for Brazil. The US barrels actually come in at about 14 and a half. UK here in the North Sea ended up about 5,000 barrels per day. So, you know, we talked about new plays. This is clearly one of them, Subsalt Brazil, deemed to be extremely challenging, etc. But the prize is just the significant volumes of oil that are coming out for every well that you drill, and that's just going to continue to incentivize further investment here. And again, this is kind of just hitting home that particular point. You know, if you are the bigger operator, you're realizing things are expensive, it's riskier, but the economics, and this is just a chart of the net present value for Brazil, for an example such as Brazil, and if you can add more floating production FPSOs to these barrels, then the unit economics of your barrel just keep rising. The NPV, net present value, keeps increasing with the years from discovery. So this is what companies are looking at, and this is what they're now talking about, FPSOs. The more FPSOs they can add, the better, and the greater the value proposition to them. So I mean, that's kind of a big part of the strategy here with some of these new plays. Elsewhere, if you look into the rig market, and getting back to the question, the importance of deep water to supply, we're showing that there's a lot of resource. We clearly need service companies or rigs to be stepping up to the challenge, and on the estimates that we have and the visibility that we have, you can see the number of deep water rigs is going to step up materially in the next 2 years to help this particular challenge. So we're kind of doubling here in terms of deep water rigs. And for service companies, therefore, we see that as a pretty attractive revenue opportunity, which is the chart on the right-hand side. But you know, it's important to kind of match the resources, the appetite, the economics, and the service capacity coming through at the other side, which, based on this, is happening. The other aspect is, even though the economics look good, the initial upfront capex, the initial economics are obviously more expensive than existing producing barrels. So what happens is, a number you're probably very familiar with is finding and development costs per barrel, a very crucial metric for us in my world to kind of analyzing companies across the spectrum. And what that number has been doing has risen from $5 in the year 2000 to about $20 today. And we think as you go into deep water, that number will continue to increase. So at $20, you can see a lot of deep water fields being developed for $30 to $40 per barrel. Just the capex divided by the barrels which are coming out of that discovery. And what that does is it's a very important component to what's called marginal cost which is kind of the price where we think oil prices should settle long term. And when you do that type of analysis, we already get to $90 per barrel. So you look at the most expensive part of your production cost curve, which is up here on the right-hand side. In the last few years, it's coming in and around $90 per barrel, but only with, think about that, only with 6% of deep water production incorporated within that kind of supply curve. If we're going to continue to push into the deep water, those developments are more expensive. They will help to support this marginal cost, push it higher, and ultimately help support the oil price to move higher as well. And I just, sometimes these numbers are really interesting, but this is like 50 biggest companies around the world, and that's just really showing you how all the costs for the industry have grown at double-digit percentages over the last 10 years. So whatever number you look at, whether it's production costs, exploration expense, companies used to spend 63 cents per barrel in exploration. Today that's $2. Production costs 3 are now 21. The cost I was looking at is this organic finding and development cost, $5, up to 17.5 at the end of 2011, but moving up towards 20. But you can see the trend. If you look at this column, you think about taxes, whichever cost line you want to look at, it's double-digit kind of inflation levels that we're actually experiencing here. So very positive for the oil price, therefore very positive for companies progressing further to develop these deep water resources that we've discovered. And that's us embedding that in just to really paint the picture of what oil prices have done and what they may do over the next 5-6 years. So, which is very important for companies to make that decision to develop the offshore. Red is Brent, and the black dotted line is that marginal cost estimate. We think it will continue to increase like this, and prices in red or blue here will trade above that level. So all in, very supportive from our perspective for continued deep water development. But the other side of what's happened in the last few years is, I mentioned at the beginning, we have to split out those discoveries into oil and gas, because when you split it oil and black and blue for gas here, you can certainly see in the last 2 years you've seen a lot of discovery coming through, but it's predominantly natural gas. And then when you kind of think about the big play opening areas, Brazil here I've plotted in green, so you can see the importance of Brazil coming through. And then here in the last 2 years, East Africa in red. So it's not all oil, it's significantly more natural gas for the first time in a long time. And that has particular consequences, because making the investment decision on these is very different to oil. So if you want to get a floating FPSO in an oil field, that's a much, let's say, simpler challenge to considering developing offshore natural gas, where you need to know that the gas price, you need these blue lines or these black lines, which are Asian gas prices and European gas prices linked to oil. And really you need to be pretty sure that this is going to stay around in order to start thinking about these deep water gas developments to bring them on stream. Red is the US gas price, as everyone's familiar with. The green is kind of the UK price. But, so this is the question. So we're talking about oil prices remaining high. The economics work for oil fields. The appetite is there. But when you see that a lot of it is natural gas, then it's a different discussion altogether. So and I think companies will be struggling with this at the moment, and you may not see a lot of these gas discoveries suddenly hit development within the short term. So, I want to kind of finish it off here. So if we go back to the first charts and think about deep water oil production is 7% of current supply. For the oil side, we remain quite optimistic that we'll see a steady progression of those types of developments. And here we're just taking a step out, right out to 2020. This is what we looked at, this chart truncated here in the first chart, but as you can see, the deep water we expect to grow. And that's looking at the projects and the economics and the oil price. So it's going to continue to be a very important part of global supply, and maybe by 2020, it could end up being 11-12% from the current 6%, so it's really doubling. I haven't plotted it for natural gas because it's only 3% today. There's a lot of deep water there, but we discussed the risk, and I'm not so sure the 3% doubles to 6% by 2020. I think it probably stays around that level. So, you know, from a kind of looking at companies and seeing the value opportunity that can be created, we would probably be spending most of our time looking at the oil discoveries and how quickly they can be monetized and brought through production. So, yeah, I think that's where I wanted to end it, just leaving it kind of open, setting the scene for some of the more detailed discussions today on new plays and exploration. So I'll finish there and take any of your questions you might have.
Thanks, Oz. Just to say, I mean, there's a lot of detail in there. By the beginning of next week, Oz's slides will be online on our website.
Yep.
So those of you who've been scribbling, well done. But all the material is going to be there. Yeah. Okay. Any questions for Oz? Let me ask one, because you see a lot of companies. Yeah.
Yep.
And I'm got to be careful which hat I'm wearing here. But as an independent consultant, if you're looking at a billion-barrel deepwater field and you're contemplating drilling a $250 million exploration well, followed by 3 or 4 appraisal wells, this is talking about a billion-dollar E&A program before you have something that you could even put up for declaration of commerciality. Yeah. Do you see any pushback on costs? I mean, if you look at the mining industry, because cost did this, the mining industry has not collapsed, but restructured, retrenched, changed over the last 2 years. Do you see any pushback from companies on costs, or is everybody happy with this kind of price of oil rises, cost of supply, cost of development and exploration rises, but we're kind of all in this together? Do you get my question?
Yeah, and I think you can immediately pinpoint the 2 areas where that risk has arisen and is curtailing future investment or will, and that's Canadian oil sands and Australian onshore gas development. So all those risks you talk about, labour rates, cost inflation, rapidly accelerating, is putting the brakes on sanctioning and moving forward with even further investment. I think in terms of the deep water, we're not really seeing that. In fact, more of the opposite. You're seeing companies talk about securing rig contracts for 10 years. I mean, Transocean did talk about this 2 weeks ago. So not 3, 4, 5, 6 years, but 10-year rig contracts, which would lock them in at a cheaper rate than the spot price today, but giving them secured access to rigs to go off and drill the billion-dollar exploration programs, but with the certainty of having the equipment. So it's very dependent on which resource type you're actually looking at. But deepwater, I think, you know, they're all on the same page. They want to test new plays, and I think, you know, even for instance, one company, Total, just had their strategy day this week and talked about taking new play ideas outside of the Atlantic Basin and going into, you know, the Black Sea, other basins, and testing them there, and really wanting to test that idea. And that's kind of more common rather than, hold on, costs are getting ahead of us.
Anybody else? Other than me. Yeah, please. Just hang on to the microphone. Can you say who you are?
Mark Redway, RAB Capital. Your very first slide showed the exploration costs, I think, across the last decade. If that were to be readjusted to take into account of inflation, or we look at the actual number of wells being drilled, has that changed in such a dramatic way?
This one, this chart.
Yeah. Yes, that's right. Yeah.
Yeah. So. Yeah, I mean it's a fair point. We have had double-digit inflation in 2004 to 2008 versus single-digit inflation in all aspects of development and exploration capex. So true, within the 2004 period to this period, a large part of that is certainly exploration. but I didn't plot it here, but you can plot it as a percentage of total capex for a lot of these companies in the last 5 years. So in this period, the inflation has slowed altogether. I mean, you can look into 2008, 9, 10, 11, 12 and see 1 to 2% inflation levels, and yet the absolute numbers are still rising. So that's activity-led rather than cost-led, which gets to your question, but that's primarily focused in that period of time.
Well, I suppose another way of asking this is if, given that there have been more expensive deep water wells, are the actual number of wells, exploration wells being drilled declining? In other words, we are drilling more higher potential deep wells rather than more shallow water or onshore exploration wells.
Yeah, it's a very difficult number to track. I don't have the answer because I'm tracking discoveries which are announced. You don't often hear about all the dry wells, so whatever number I gave you wouldn't actually be completely accurate. So it's just a tough number to get a handle on.
Peter Nichol from Lockheed Energy. Your table with all the long-term numbers, if I read it quickly and it flashed past, you seem to suggest there's only a reinvestment ratio of around about 100% for all this over time, if I average it quickly enough. So is that basically saying this is barely an economic activity?
Well, that's the thing. I mean, even though the oil price has gone from 25 average in 2001 to 111 Brent, think about that. The free cash flow, FCF, back here was 60 cents. Today, okay, it's $3. Even though you've had that scale of an increase in the oil price. So to the cost inflation point, it's come up and eaten away a lot of the rent here. But also, look, what's interesting is that the revenue you get, $14 per barrel revenue versus 24, so a $10 differential. Here, $66 per barrel versus the market price of 111, so $45 differential, a kind of realization spread and opportunity lost, and that's because of lower quality oil coming through, a lot more natural gas coming through the production mix, which is regulated gas prices, and ultimately, as your costs come up, they're just squeezing this. You have to keep investing, but you're not ending up with much left after that.
So the industry isn't basically making its way overall. Is your capex there for all projects or just for offshore?
No, this is everything. 50 of the biggest companies globally for everything they're undertaking. Yeah. So maintenance capex as well on mature assets. That's true.
Yeah, please.
Roger Derry. Your slide near the end showing the recent discoveries, it's dominated by Brazil and East Africa. Are the very large Kurdistan finds in there as well?
Yeah, so this one this is just offshore, so that's water depth on the y-axis. So you're right, that would have to be plotted separately. It would look large. And again, you'd have the range, but you have the range. It's not pure oil, as you know. There's condensate. There's been some big natural gas discoveries as well. So it's an interesting question to see how it plays out, but it certainly wouldn't be 100% oil.